Today's guest is a supporting sponsor of Liberty in Finance. Welcome back to Liberty in Finance. We're glad to have this returning guest who's an insider in the gold mining royalty industry. Kyle Floyd is the founder and CEO of Vox Royalty. He joins us again this Tuesday, April 5th, 2022. Kyle, thanks for coming back on Liberty in Finance.
Thanks, Dunning. It's always a privilege to be with you.
We wanted to get you back on because there's some very momentous things happening in the industry. People have been quite a bit chatting in the last week about pointing out a breakout signal in the gold mining index of stocks. The world of those who are watching that closely saying this is even preceding a breakout in the gold price. The gold price has been, although near within a spitting distance of all-time nominal highs for some time now, has been trading mostly sideways in a trading channel for some time, and yet we're seeing an anticipatory breakout in people getting excited about the prospects of the outsized gains that will be experienced by those holding mining companies at the time. In the past, when we've had you on, well, I guess I'm going to zero back in on royalties after that, but first, could you just address your perspective of that phenomenon that we're seeing, of this anticipation of the potential for outsized gains of those who are watching the mining sector closely?
Yeah, there's so many developments right now from an inflationary perspective, from a geopolitical perspective, that are really buoyant and should be positively correlated with moving the gold price north. So, at a personal level, I share that optimism and that excitement. Talking to the abundance of industry insiders that we do, everyone is pretty bullish on the metals right now. And I think probably one of the more key factors within that is when we're speaking to, call it a more generalist investor or a non-metals focused or non-gold bug type investor, they're wanting information and they're looking for avenues to deploy capital into the metals right now. And I think that's kind of the bellwether of the industry are the generalists coming into the sector, are they looking for the right kind of exposure? And we're certainly seeing that from the intelligence that we're gaining.
So we've had you on before several times talking about what's different about royalty companies from an operating company that actually runs a gold or silver mine. And in fact, before we had you on talking about that, we had Rick Rule on talking to us several times about why he considers, especially for beginning investors who are just getting their feet wet in the precious metals space of investing, consider royalty and streaming companies because of their unique advantage of their financial and business model. So can you remind us why royalty companies are uniquely positioned to benefit from increases in the metals prices and increases in operations volume, that sort of thing, by operators, and what makes a royalty company different from a gold mining company in that regards?
Absolutely. And I'll start with the upside potential that royalty companies present that I don't think is as well understood as maybe it could be. So first and foremost, royalty companies, you're typically taking a percentage of the top line revenue generated by individual mining projects. So it's that top line, which means usually production times metal price. So you usually are getting the upside in both production increases and also price increases in the underlying commodity. And why that's so important is because that's top line revenue interest. We're not exposed to the input cost structure and the fixed cost structure of mining companies, which is significantly going up because of inflation. So the same inflationary pressure that we're trying to get essentially hedge against or get exposure to something that can grow and be successful in inflationary times, that issue is afflicting mining companies. And so Vox uniquely sidesteps that issue and does not have exposure to the rising input costs and rising fixed cost structures of mining companies. So that's really important to understand. The other important thing to understand is all the growth, and you talked about there being some buoyancy in interest in investing in mining companies right now and that breakout. That's really helpful for a company like Vox because at the end of the day, it's great for the operating partners that are actually doing the hard work, they're running the mining operations, to be well capitalized and well invested in. And that's incentivizing them to do a couple things. One is metal prices rise, that incentivizes additional drilling. So that's both increasing confidence level in what they already have, and then looking for new discoveries and extending existing resource bases. So we're seeing all of that happen with our portfolio, and we're exposed to that. And then if you get a rising metal price environment, all of those future ounces, all of that increase in production is obviously multiplied and compounded by a higher metal price. So that's really significant for the royalty company. because we're not contributing that capital. So if your basis is zero in terms of contributing to that additional revenue opportunity, it's a very, very high leverage return for our shareholders. So that's really significant to understand. And then you get into some of the risks, and also what I'll touch on, and this is a risk and a reward for royalty companies, is we're not diluted. So when we don't contribute that capital to contribute to that growth and that upside, we're not diluted. So it's usually a perpetuity interest in that revenue, which gives you all those benefits that we touched on. And then from a risk mitigation standpoint, we have 55 royalties and streams. If you're looking at royalty companies, they should have a number of different assets that's offering you diversification of risk. So someone like Vox with 5 producing assets, expected to be 13 as we get into what I would say 2023, 2024, with upside to those numbers, you're getting a lot of diversification in a small cap company. So it's that lower risk and what I believe in many ways is higher upside, higher leverage exposure, because you're getting an undiluted, non-capital contributed upside to these mining operations. So there's a lot to unpack with the royalty companies, but that really, I believe, is something that investors are missing, which is a lot of upside and a lot less downside. It's
funny. There's so many sayings in folk culture and everything about, I just want the fruit. I don't want have to all the work of tending the orchard or whatever. But it's almost like that's what royalty companies have positioned themselves to. They're able to basically take the cream off the work and the result and the fruits of the operations, companies that are operating the mines, without having to be subject to all of those burgeoning price inputs that are straining right now in an inflationary environment. Can you talk to us about a brand new press release that just came out today from Vox Royalty, what it contains at a high level, but what it signifies in your view? What's the big picture takeaway for people?
The big picture takeaway is just what we talked about. It's all the benefits that a royalty company should be delivering for its shareholders and into its business. And for Vox, really, we started building this business almost 10 years ago. We've talked about it previously in the show. Royalty companies have to be able to find value for your shareholders. A lot of royalty companies are buying an asset at 1x NPV and then hoping to essentially trade off an arbitrage value or needing a lot of things to go right just to get their capital back for investors. And that's one of the, let's talk about some of the negatives of royalty companies. When companies are paying premiums to net present value for royalties, I think that's a real problem for investors because there's a lot of things that are going to have to go well just to get your money back. Vox does it very much the opposite. We've been around for 10 years. We've built a strategic IP, intellectual property base, in the form of a royalty database that has over 8,500 proprietary third-party royalties in it. So we're able to look through that database to find assets that have really, really good fundamentals that our mining engineers and our geologists are doing the hard work on the front lines to really figure out whether we like this asset, how much do we like this asset, and how much are we willing to pay. And being able to find these assets at great value that have great upside, lower risk, and bring those into the portfolio. And we've done that really well. So today's news release is just really kind of the further evidence of us as a management team really continuing to find great value for our shareholders. I'll summarize the high level and then we can break it down a little bit. But this is news releases summarized from 5 different operating partners that are moving Vox royalty linked assets forward. 2 of the operators announced a doubling of the resource base. So where we bought the royalty, and these are all over the last couple of years, to where it stands now, the resource base has doubled. So we talked about what upside do you get in a buoyant commodity cycle for Vox shareholders. Well, doubling the resource base from where we bought it is fantastic. That's a tremendous amount of value being created for Vox shareholders. Again, we're not contributing to the hundreds of millions of dollars that's being spent to advance these projects in that fashion. We had a new discovery crystallized with over 200,000 gold equivalent ounces. So that was very key. That was a royalty that we bought for $50,000 based on current projections. If you kind of extrapolate what's happening with that asset, it could generate 50 times what we invested into it. And then you've had announcement from Zijin, who's a $30 billion market cap operator out of Hong Kong. They operate the Janet Ivy project, which we have a royalty over. They announced their $400 million expansion of that project is well underway. It's already producing for us. That increases the revenue profile by about 5 times for us. So they said that's on track for the second half of this year. And then lastly, the Ashburton project, which is a 1.6 million ounce gold resource. We acquired that project a couple years ago. the operator Kalamazoo came out today and said, or in the past week rather, that their preliminary metallurgical test studies have looked very, very positive, and that they are commencing a study internally now for a development case to bring this asset back online. It was a previous producer over a decade ago. So all of that sounds like a lot, and it is a lot, and that's hundreds of millions of dollars being spent increasing the value in our portfolio. And a lot of that is not reflected right now in our share price or our valuation, but shareholders are getting the benefit of that. And that's what a good royalty company offers to investors, is that upside without paying for it on an undiluted basis over a wide array of assets, increasing both production profile, increasing resources in the ground, and ultimately really providing a tremendous amount of value for our shareholders.
One of the things that I couldn't help noticing over the past year since we've been bringing this message forward for our viewers so that they can dig into it and learn more about it themselves and see the opportunity is how resilient Vox Royalties stock price has been in the past year relative to many other either mining companies or royalty and streaming companies, where a lot of these other companies got hit, pretty hard in the last, in some of the quarters of the last year with downturns or volatility in the market in general. But Vox has been relatively buoyant and relatively, once it made the pop up above, up around $3 a share from, less 1.75 that it had been, prior to that, it's been remarkably, maintaining and yes, it's traded more somewhat sideways, but staying higher than a lot of its peers have relative to, the peaks that they had been at previously. And can you talk to us about, what your takeaway is on what you think the market is saying about the confidence in the value proposition that's seen in Vox in the face of more volatility in some of the other companies in the sector?
Yeah, for Vox Royalty Corp and our shareholders, talking about maybe the buoyancy of our share price, a lot of that, I believe, is linked to what we've been able to demonstrate and validate to the markets and for our shareholders, and that we're finding great assets that are increasing in value in the portfolio. And it's still far from reflected, I believe, in our share price. And so we're that unique company that I believe is a value play and a growth play. I think in the what's called the trading industry, they call that GARP, growth at reasonable prices. I think we fall into that category, and fundamentally, we continue to execute, we continue to deliver. We're finding really tremendous assets for our investors at very good prices, and they're developing within the portfolio fantastically. And so I think investors are starting to understand that Vox is a really good place. We're not the largest company out there. We're not Franco-Nevada at a $30 billion market cap, so we're not for everybody. But for investors looking for a small cap place to put some capital in this type of environment, I think Vox is a really good company to consider, because we're continuing to offer growth and we're continuing to do that on a diversified basis. So you get upside with a lot less risk. And investors, I think, are starting to pay attention and be aware that Vox is out there and offering this type of exposure.
Circling back, if we could, just to really make sure that people are clear about the point about the difference between investing in a mining company versus in a royalty company. I think this is something that Rick Rule has talked to us about in the past, is that when you invest in a mining company, you're in one sense becoming a beneficial owner of whatever ounces of metal they do have in the ground already, or they may identify in the future. But you're also signing up for the costs that are going to be necessary to extract those metals from the ground, and that means a whole host in your jurisdictional risks and all kinds of things. If you invest in a royalty company, if you could clarify again the distinction there, you are still becoming a beneficial owner of a percentage of the metals that are coming out of that mine, at least being able to benefit from that financially without taking on those same costs on the input side. Is there any other distinction around that you think people need to understand when they're contemplating? Because a lot of people are new investors. This is new to a lot of people. If they're looking at the potential of investing in a royalty company versus a mining company, what are they actually buying if they're buying shares of a royalty company?
Well, a couple things first. For new investors in the space, it's a very esoteric landscape that we live in. Mining companies have a lot of nuanced risk that doesn't jump off the page to investors. And so one of the reasons you can look at a royalty company, and not all royalty companies are created equal, and the way Vox was built is not necessarily the same in every royalty company. We have mining engineers and geologists on the front lines of our business doing the hard work and hard due diligence to understand the quality of these assets, the risks of these assets, and also the upside of these assets. And so for a new investor to the space, it's something to be very aware of, that there are risks that are pertinent to mining companies that are really hard to understand if you haven't been in the space for a while or you're not a technical expert, a mining engineer or geologist. So we're doing that for investors. I think that's really important to understand kind of at the outset. And then to the second point, Donegan, when you look at a royalty company, the other thing to note is, yes, we are not exposed to the inflationary input costs that are afflicting the mining companies. And inflation, yes, very buoyant, very productive for commodities. I think we've talked about that previously over the previous 9 inflationary regimes. Commodities have been one of the standouts in terms of performance in inflationary times. The problem is that the same inflationary issues that you're trying to solve for are afflicting mining companies almost more acutely than a consumer. What are their big costs? Their people, those costs are going up. It's diesel, those costs have gone up exponentially over the last couple of years. So you're seeing all their input costs. They need metal too, just to create the infrastructure around their projects. So you're seeing a tremendous amount of cost exposure to the miners. That being said, metal prices are expected to outperform that. Well, a royalty company just takes the exposure to that top line revenue opportunity. We're not exposed to both the current costs that's increasing drilling, that's increasing development studies and development work, and we're not exposed to the increased cost that will be there when they start pulling metal out of the ground and producing. So Vox puts you in a very preferential position. And then lastly, that interest is not diluted. When we don't contribute capital to those growth efforts and the capital that the mining company needs to continue to operate and produce, we're not diluted. So when you own a mining company, you own the equity interest in that. What you are eventually expecting to get and generate from a cash flow perspective by owning a share of that company can be a lot less because of dilution. That doesn't mean that Vox is completely immune to that, because if we go raise capital, yes, your interest in our overall project can be diluted, but the key differentiating point is our underlying assets, our exposure to those assets is not diluted essentially into perpetuity. So that's the benefit of owning Vox, is that you get the upside of these assets without the potential of those assets being diluted at a Vox corporate level.
You just mentioned in your press release, and by the way, folks, there's a link to the press release in the description of this video. Make sure you take a look at that. You mentioned in that these are some actual announcements of things that have actually just happened from some of your member operating companies. But you've talked to us in the past about your prospects going forward of bringing online additional operating companies into the portfolio of operations that shareholders of Vox will enjoy participatory ownership of. Your quick outlook for the timeline that you see now and the kind of scale that you see forward for additional new operations coming online or new acquisitions in the future.
Yeah, well, one of the big announcements that we had going back a couple of months now was the Limpopo royalty acquisition. So that was a royalty over a previous producing project. So one of the most significant platinum group metals assets on the planet that has already been in production. It went out of production because metal prices had dropped to about 1/8, 1/10 of where they are today. That Sibanye-Stillwater, the $10 billion multi-jurisdictional producer, has said is in their 2 to 5 year timeline to bring back into production. That's 50 million gold equivalent ounces under resource. It's probably one of the most productive ore bodies, and they've already de-risked it, because if you look at an ore body like this, the big upside is platinum, it's palladium, it's gold, it's nickel, it's copper. It'd be very hard to find a more balanced, productive metallurgical composite than what that asset is right now. What you would typically say is one of the risks is, can you actually process those metals out? The reality is it's a past producer, and they produced rather successfully prior to going on care and maintenance, because metal prices have dropped so significantly. So that's, I think, exemplifies what Vox is able to bring to our shareholders. That royalty, in my opinion, is worth, when it's back into production, that could be $100 to $200 million royalty. And that's what we're looking for, and that's what we're bringing to our shareholders. Now, things have to happen for that to be realized. Analysts are putting about a $30 million valuation on that asset right now. But keep in mind, we bought that for $1.5 million in stock up front. That's locked up for 2 years. That's what we're looking for, and that's what we're driving for shareholders, is that kind of growth and then continuing to find smaller deals that are going to add a lot of value for shareholders that are certainly not known about by really almost any of our competition. So it's really just a continuance of the business model and the execution thereof that I believe that we're accomplishing at a high level for our shareholders.
And if people want to find out more about Vox itself, where shall they go?
So voxroyalty.com is always a good place to start. If you want to email any questions, ir@voxroyalty.com. I'm on there quite frequently answering emails. And of course, all the typical social media channels.
We've been speaking with Kyle Floyd, the CEO and founder of Vox Royalty Corp. Here on Liberty and Finance. Kyle, you're always welcome here, and our viewers appreciate your insights into the industry, as well as your distinctions that you help clarify for people who are trying to make sense out of the distinctions that are important to understand as potential investors and new investors or expanding investors in the natural resources space. And as always, thanks for joining us here on Liberty and Finance.
Of course, always my privilege. Thanks, Senegan.